Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, I'm Sandy, your guest host from Keller Williams Legacies, here to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hamoen here. This is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
All right, Steve, let's kick things off with some exciting news from the Canadian Real Estate Association. They announced that August saw the most home sales in 4 years, with residential transactions rising by 1.9% compared to last year. That's quite a jump, isn't it?
Absolutely, Sandy. We're looking at 40,257 home sales across the country last month. This is up from 39,522 in August 2024. It's not just a year-over-year increase, but also a 1.1% rise month over month. That's marking the fifth consecutive month of growth in sales.
That's right, Steve. And while we often see the Greater Toronto Area leading these gains, this time, sales there were slightly down month over month. But the slack was picked up by cities like Montreal, Greater Vancouver, and Ottawa.
Exactly, Sandy. According to Sean Cathcart, CREA's senior economist, we might see this upward trend continue into the fall. He mentions that the beginning of September usually brings a surge of new listings, driving sales. So, there's potential for an increase in the coming months, especially if the Bank of Canada decides to cut rates soon.
That's interesting. The central bank's interest rate decision is on the horizon, with expectations of a quarter-point cut to 2.5%. That could really influence the market, don't you think?
Yes, indeed. Financial markets are anticipating this cut. It would end a streak of 3 consecutive holds. This decision could draw more buyers off the sidelines, especially in regions like Atlantic Canada, where there's been some muted momentum lately.
I read that Matt Hansberger from Royal LePage Atlantic described the Maritime housing market as more of a kiddie coaster compared to the roller coaster of Toronto. He mentioned that despite the earlier downturn due to tariffs, the region is slightly ahead of where it was last year. That's a hopeful sign, right?
Yes, it's a positive outlook. Hansberger pointed out that even with the uncertainties from tariffs and geopolitical factors, the market is building momentum. He emphasized that sellers need to price their properties appropriately, as buyers are cautious and not inclined to engage in bidding wars right now.
Right, and it seems like the market remains healthy. CREA noted that new listings were up 2.6% month over month in August, with 195,453 properties listed nationwide. That's an 8.8% increase from last year. It reflects a robust market where, if priced right, properties should sell in a reasonable time frame.
Exactly, Sandy. TD economist Rishi Sondhi also commented on the tight supply and demand conditions across several provinces. While some markets like British Columbia and Ontario favor buyers, the average prices are still being lifted by more expensive housing. So it seems the trend might continue. What's the trend?
I guess it all comes down to pricing and timing. It's an intricate dance between supply, demand, and how external factors like interest rates play into it. It'll be interesting to see how the fall season unfolds. So, Steve, it seems like Toronto's housing market is experiencing quite a shift. Prices are dropping, which might spell trouble for investors and landlords, but it's a breath of fresh air for first-time buyers. What do you make of this development?
Well, Sandy, it's definitely a mixed bag. For investors, the drop in prices is certainly not ideal, but for those first-time homebuyers who've been waiting on the sidelines, this is a golden opportunity. Leah Zlatkin from Mortgage Outlet mentioned that many first-time buyers are finally able to make a move because of the more reasonable pricing on townhomes and row homes. It's a significant shift from the bidding wars we saw during the pandemic.
That's right. The decline in prices for detached homes, semi-detached, and townhouses in the Greater Toronto Area is quite notable. It's down by 7.5%, 4.2%, and 3.8%, respectively. For those who were just on the margins and couldn't afford to buy before, this market is suddenly offering them a chance. It seems like a hopeful moment for them, don't you think?
Absolutely, Sandy. And the fact that smaller markets outside the city, like Tottenham and East Gwillimbury, are also becoming more accessible is encouraging. Leah Zlatkin pointed out that buyers can purchase a home for around $750,000 and still commute to the city. Plus, with the absence of bidding wars, buyers can get more bang for their buck.
It's interesting to hear that even with federal and municipal employees heading back to the office, many still find core living unaffordable. Chris Allard from Smart Debt Mortgages noted that living in central Toronto remains out of reach for most workers earning between $70,000 and $140,000 annually. So, while prices might be dropping, affordability is still a challenge for many.
Indeed, Sandy. But there's optimism in the air, especially with the Bank of Canada expected to cut rates soon, which could lead to lower variable and fixed rates. Leah Zlatkin highlighted that bond yields are down, and although we haven't seen a decrease in rates just yet, it's likely on the horizon. This is good news for those looking to enter the market while it's still accessible.
And with the Canadian Mortgage Summit coming up, there's a lot of attention on how brokers and borrowers should navigate the current climate. Leah Zlatkin's panel will be discussing strategies for dealing with potential challenges, like defaults and economic uncertainties. It's all about equipping brokers with the tools they need to guide their clients through these times.
That's right, Sandy. Understanding lenders' risk appetites and the trends in the mortgage market is crucial for brokers. It's about making informed decisions and finding the right products to suit clients' needs. As always, staying informed and adaptable is key in this ever-evolving landscape.
Steve, let's dive into the potential interest rate cut by the Bank of Canada. While many are hopeful that a rate cut could ease the burden on mortgage holders and stimulate the housing market, John McFarlane's recent article highlights that it might not be the silver bullet everyone expects. What are your thoughts on this?
Well, Sandy, McFarlane makes some valid points. He argues that while a rate cut could lower borrowing costs, it's not guaranteed to have a significant impact on the housing market. The underlying issues, like housing supply shortages and affordability challenges, aren't going to be resolved by a mere reduction in interest rates.
Exactly, Steve. McFarlane points out that even with lower rates, the high cost of homes, especially in major cities like Toronto and Vancouver, remains a barrier for many potential buyers. Moreover, with the recent surge in housing prices, a small decrease in interest rates might not translate to substantial savings for new buyers.
That's right, Sandy. The article also mentions that a rate cut could potentially lead to increased demand, which might further drive up prices if the supply doesn't catch up. It's a complex situation where a rate cut alone might not be sufficient to address all the challenges faced by the housing market.
And let's not forget about the broader economic implications. McFarlane notes that reducing rates could also lead to inflationary pressures, which might counteract the benefits of lower borrowing costs. It's a delicate balance that the Bank of Canada needs to consider.
Absolutely, Sandy. The article emphasizes the importance of a comprehensive approach. While interest rates are a crucial tool, they need to be part of a larger strategy that includes policy measures to increase housing supply and improve affordability. It's about addressing the root causes rather than just the symptoms.
Well said, Steve. McFarlane's article serves as a reminder that while the anticipation of a rate cut might bring some optimism, it's not a cure-all for the housing market's issues. Stakeholders need to focus on long-term solutions that address both supply and demand challenges.
Exactly, Sandy. It's about creating a sustainable and balanced market. As always, staying informed and looking at the bigger picture is key for anyone involved in real estate and mortgages.
Steve, let's talk about one of the pressing issues in the Canadian real estate market this week. We're seeing a significant surge in mortgage arrears at Canada's Big Six banks. This rise is outpacing the national average and is quite concerning, don't you think?
Absolutely, Sandy. It's certainly a red flag. The Big Six banks usually have lower delinquency rates, so this uptick is an early warning sign of potential financial stress. 5 out of the 6 banks are now exceeding the national average in mortgage arrears. This shift could indicate deeper issues within the financial landscape.
And it's not just the mortgage arrears that are troubling. Toronto's unemployment numbers are climbing too. The latest figures show that unemployment in the Toronto region hit 392,300 in August, which is over 11% higher than last year. That's now more than 1 in 5 of Canada's unemployed. It's a staggering number.
Yes, it's quite alarming. Toronto's long-term real estate prospects could be hampered by this deteriorating job market. With such high unemployment, the recovery for the real estate market in Toronto seems unlikely to be swift. The Toronto Census metropolitan area now has some of the highest unemployment rates in the country.
And when we look at the broader picture, there are concerns about Canada's household debt. It seems that the falling debt-to-income ratio we've seen since 2021 was more a result of surging population growth rather than actual debt reduction. Now that growth is slowing, the ratio is rising again, marking the third consecutive quarterly increase.
That's a crucial point, Sandy. The perceived improvements in household debt were more about optics than reality. With the current slowdown in population growth, the debt-to-income ratio is climbing, which could pose a risk to economic stability if not addressed.
On top of that, Canadian satisfaction with life is reportedly declining, especially in Alberta and Ontario. According to Statistics Canada, life satisfaction dropped from over 90% before 2021 to just 77% by the second quarter of 2025. Alberta scored the lowest, followed closely by Ontario and British Columbia.
It's a concerning trend, Sandy. The decline in life satisfaction could reflect broader economic and social challenges. It's important for policymakers to consider these sentiments when addressing national issues, as they can significantly impact consumer confidence and spending.
And with BMO's forecast that the Bank of Canada might make 3 interest rate cuts before spring 2026, there's a possibility that these cuts could alleviate some pressure. But as always, there are uncertainties, like inflation, that could derail these plans.
Exactly, Sandy. While the prospect of rate cuts could bring some relief, we must remain cautious. Sticky inflation could complicate the situation, and with another consumer price index report due before the bank's decision, any unexpected changes could shift the outlook.
Shifting gears a bit, Steve, let's look at the broader economic landscape. This week, there's a lot of focus on U.S. retail sales and Canadian housing figures. It's a big week with several economic indicators due to be released. How do you see these figures impacting the market?
Well, Sandy, the U.S. retail sales figures will certainly be a key focus. They're a significant indicator of consumer spending, which is a major driver of the U.S. economy. A strong showing could bolster confidence in the economy's resilience, possibly influencing Canadian markets as well, given the close economic ties between the two countries.
That's true, Steve. And on the Canadian side, we'll be watching the housing starts and the consumer price index closely. The housing starts have been on an upward trend with a 3.7% increase in July, which is encouraging for the construction sector. But it's the CPI that could really sway things, especially with inflation concerns looming.
Absolutely, Sandy. The CPI data is crucial as it could signal future moves by the Bank of Canada. If inflation pressures ease, it might give the central bank more room to maneuver on interest rates. However, persistent inflation could complicate matters, especially if it affects consumer purchasing power and housing affordability.
And with the Bank of Canada's rate decision looming, these economic indicators could provide some insight into their next steps. While they've held rates steady at 2.75% in July, there's speculation about potential changes depending on these latest figures. It's a delicate balancing act for the bank, isn't it?
It certainly is, Sandy. The Bank of Canada has to weigh the need to control inflation against the need to support economic growth. The upcoming data releases will be critical in shaping their policy decisions. It's all about finding that sweet spot where the economy can grow without overheating.
And looking at the manufacturing and wholesale trade figures, it seems there's some positive momentum with manufacturing sales up by 0.3% and wholesale sales rising 0.7% in June. These are signs of resilience in the sector, which is good news for the broader economy.
Yes, these figures are encouraging. They indicate that despite some challenges, there is underlying strength in the manufacturing and wholesale sectors. This could help buffer the economy against any potential downturns, providing a bit of a safety net.
Well, Steve, it seems like there's a lot to keep an eye on this week. The interplay between these economic indicators and the housing market will be fascinating to watch. As always, we'll be here to break it all down for our listeners.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your home ownership goals. Catch you next time and stay informed with the latest industry insights.